Hello everybody, welcome to How to Econ. Let's take a look at the topic of inflation. Inflation is a general and ongoing rise in the price level in an entire economy. To calculate the price level, we use a basket of goods and services. It is a hypothetical group of different items with specific quantities of each item. It is meant to represent a typical set of consumer purchases. For example, in this table, we have a hypothetical basket of fruits with specific quantities of each fruit. Those quantities are assumed to be constant. That means they don't change with time. Each year, the price level of this basket is the sum of the amount spent on each fruit. In 2001, the price level equals 10 apples times $0.5 each, plus 12 bananas times $0.2 each, plus 2 pounds of grapes times $0.65 each, plus 1 pound of raspberries times $2 each. We have the price level in 2001 is $10.7. Doing the same thing for 2004, taking the specific quantity of each fruit times the price per unit in 2004, we will get the price level in 2004 is $16.31. This is higher than the price level of this basket of fruits in 2001. It signals inflation. Inflation rate is simply the percentage change of the price level between 2 years. For instance, to calculate the inflation rate between 2001 and 2004 for our fruit basket, we will calculate the percentage change in the price level from 2001 to 2004. We take the price level in 2004 minus the price level in 2001, then divide it by the price level in 2001, and finally multiply it with 100. The price levels were calculated a minute ago. So we have 16.31, which is the price level in 2004, minus 10.7, which is the price level in 2001, then divided by 10.7, then times 100. We get the percentage change in the price level, or the inflation rate between 2001 and 2004 is 52.43%. That means the price level has increased by 52.43%. This could be considered hyperinflation, which is an outburst of very high inflation, often above 10% inflation rate. Now, if by any chance we have the percentage change in the price level between 2 years is a negative number, that means we have deflation, which is the decrease in the overall price level. One more time, please remember that inflation or deflation does not refer to a change in relative or individual prices. They refer to the price level in an entire economy. Inflation means the price is increasing, and deflation means the price is decreasing. The numerical results of a calculation based on a basket of goods can get a little messy. This simple example has only 4 fruits and the prices are in small amounts. If the list of products were much longer and we use more realistic prices, the total quantity spent over a year might be some messy looking number like $17,147.51 or $27,654.92. So to simplify the task of interpreting the price levels for more realistic and complex baskets of goods, economists typically report the price level in each period as an index number rather than as the dollar amount for buying the basket of goods. Economists create price indices to calculate an overall average change in relative prices over time. Index number is an unit-free number derived from the price level over a number of years, which makes computing inflation rates easier since the index number has values around 100. To convert the money spent on the basket to an index number, economists arbitrarily choose 1 year to be the base year, or starting point from which we measure changes in prices. The base year, by definition, has an index number equal to 100. This sounds complicated, but it's really a simple math trick. Let's do another simple example on this. Assume that we have a basket of burgers, aspirin, and movies that a typical college student consumes per month. It has 20 burgers, 1 bottle of aspirin, and 5 movies. You have the price of each item in 4 periods. Remember, we assume the quantity levels do not change over time, only the price levels change. Please calculate the inflation rate in 2003 and 2004. If you want to do this yourself, please pause the video now, otherwise keep watching. Now, first thing we have to calculate is the price level of this basket for each year. For period 1 or 2001, we take 20 burgers times $3 each, plus 1 bottle of aspirin times $10 each, plus 5 movies times $6 each. We will get the total price of the basket in 2001 is $100. It's the same with doing grocery shopping. You sum up the cost of each item in your cart to get the total amount of money that you have to pay at checkout. Doing the same thing, we have the price level for 2002 or period 2 is $106.5. You take the constant quantity for each item times the price of those items in 2002 or period 2. Then you will get the price level for periods 3 and 4 in the same manner, multiplying the constant quantity levels with the price of each period. From there, we can easily calculate the percentage change in the price level from 2001 to 2002, or from period 1 to period 2, which is 106.5 minus 100 divided by 100 times 100, and it equals 6.5%. That is the inflation rate in 2002 or in period 2. To calculate the inflation rate in period 3 or 2003, we take the price level of 2003, which is 107, minus the price level of 2002 or period 2, which is 106.5, then divided by 106.5, finally times 100. We get 0.5%. That means the price level has increased by 0.5% from 2002 to 2003, or from period 2 to period 3. Finally, to calculate the inflation rate in period 4 or 2004, we take 117.5 minus 107 divided by 107 times 100. The inflation rate in period 4 or 2004 is 9.8%. That means the price level has increased by 9.8% between 2003 and 2004, or between period 3 and period 4. Now, let's try to calculate those inflation rates using the price index method. Spoiler alert, you should get the same numbers. Say that we choose the time period 3 or 2003 as the base year. Since the total amount of spending in that year is $107, we divide that amount by itself and then multiply by 100. This is because the index number in the base year always has to have a value of 100. Then, to figure out the values of the index number for the other years, we divide the total amounts for the other years by 1.07 as well. Note also that the dollar signs cancel out so that index numbers have no units. So the price index for 2001 or period 1 is 100 divided by 107 times 100, which gives you 93.4. The price index for period 2 or 2002 is 106.5 divided by 107 times 100, which is 99.5. The price index for period 4 or 2004 is 117.5 divided by 107 times 100, which is 109.8. From here, we can calculate the inflation rate for each period or each year using the same formula to calculate the percentage change in price level before. The inflation rate in period 2 or 2002 equals the price index in period 2 minus the price index in period 1 divided by the price index in period 1 times 100. So we have 99.5 minus 93.4 divided by 93.4, then times 100. It gives us 6.5%, which is exactly the same with what we calculated a few minutes ago using the price levels instead of price indices. Similarly, the inflation rate in period 3 or 2003 equals the price index in period 3 minus the price index in period 2 divided by the price index in period 2 times 100. And we get inflation rate of 0.5% like before. The inflation rate in period 4 or 2004 equals the price index in period 4 minus the price index in period 3 divided by the price index in period 3. Don't forget to times 100. That gives us 9.8%, just like before. The most commonly cited measure of inflation in the United States is the Consumer Price Index, or we call it CPI. The U.S. Bureau of Labor Statistics calculates the CPI based on the prices in a fixed basket of goods and services that represents the purchases of the average family of 4. The 8 major categories in the Consumer Price Index are: first, food and beverages; second, housing; third, apparel; fourth, transportation; fifth, medical care; sixth, recreation; seventh, education and communication; and the last one is other goods and services, such as tobacco and smoking products, haircuts, and other personal services, fuel expenses. If you do not necessarily purchase an identical fixed basket of goods every year, then an inflation calculation based on the cost of a fixed basket of goods may be a misleading measure of how your cost of living has changed. 2 problems arise here: substitution bias and quality or new goods bias. When the price of a good rises, consumers tend to purchase less of it and to seek out substitutes instead. Conversely, as the price of a good falls, people will tend to purchase more of it. This pattern implies that goods with generally rising prices should tend over time to become less important in the overall basket of goods used to calculate inflation, while goods with falling prices should tend to become more important. Consider as an example a rise in the price of peaches by $100 per pound. If consumers were utterly inflexible in their demand for peaches, this could lead to a big rise in the price of food for consumers. Alternatively, imagine that people are utterly indifferent to whether they have peaches or other types of fruit. Now, if peach price rises, people completely switch to other fruit choices, and the average price of food does not change at all. A fixed and unchanging basket of goods assumes that consumers are locked into buying exactly the same goods, regardless of price changes. Not a very likely assumption. Thus, substitution bias, or the rise in the price of a fixed basket of goods over time, tends to overstate the rise in a consumer's true cost of living because it does not take into account that person can substitute away from goods whose relative prices have risen. The other major problem in using a fixed basket of goods as the basis for calculating inflation is how to deal with the arrival of improved versions of older goods or altogether new goods. Consider the problem that arises if a cereal is improved by adding 12 essential vitamins and minerals, and also if a box of cereal costs 5% more. It could clearly be misleading to count the entire resulting higher price as inflation because the new price reflects a higher quality or at least different product. Ideally, one would like to know how much of the higher price is due to the quality change and how much of it is just a higher price. The Bureau of Labor Statistics, which is responsible for computing the Consumer Price Index, must deal with these difficulties in adjusting for quality changes. By the early 2000s, the Bureau of Labor Statistics was using alternative mathematical methods for calculating the Consumer Price Index, more complicated than just adding up the cost of a fixed basket of goods to allow for some substitution between goods. It was also updating the basket of goods behind the CPI more frequently so that it could include new and improved goods more rapidly. For certain products, the BLS was carrying out studies to try to measure the quality improvement. Now, imagine if you were driving a company truck across the country. You probably would care about things like the prices of average roadside food and motel rooms as well as the truck's operating condition. However, the manager of the firm might have different priorities. He would care mostly about the truck's on-time performance and much less so about the food you were eating and the places you were staying. In other words, the company manager would be paying attention to the firm's production while ignoring transitory elements that impacted you but did not affect the company's bottom line. In a sense, a similar situation occurs with regard to measures of inflation. As we've learned, CPI measures prices as they affect everyday household spending. Economists typically calculate a core inflation index by taking the CPI and excluding volatile economic variables such as energy and food prices, which can jump around from month to month because of the weather or holidays. In this way, economists have a better sense of the underlying trends in prices that affect the cost of living. It provides a better guide to monetary policy than the other indices, since it measures the more persistent underlying inflation rather than transitory influences on the price level. The BLS also calculates several price indices that are not based on baskets of consumer goods. For example, the Producer Price Index (PPI) is based on prices paid for supplies and inputs by producers of goods and services. We can break it down into price indices for different industries, commodities, and stages of processing, like finished goods, intermediate goods, or crude materials for further processing. There's also an international price index based on the prices of merchandise that is exported or imported. An employment cost index measures wage inflation in the labor market. The GDP deflator, which is the Bureau of Economic Analysis measures, is a price index that includes all the GDP components, that is consumption plus investment plus government plus exports minus imports. Unlike the CPI, its baskets are not fixed but recalculate what that year's GDP would have been using the base year's prices. What's the best measure of inflation then? If one is concerned with the most accurate measure of inflation, one should use the GDP deflator as it picks up the prices of goods and services produced. However, it is not a good measure of the cost of living as it includes prices of many products not purchased by households, for example, aircraft, fire engines, factory buildings, office complexes, and bulldozers. If one wants the most accurate measure of inflation as it impacts households, one should use the CPI as it only picks up prices of products purchased by households. That is why economists sometimes refer to the CPI as the cost of living index. The Bureau of Labor Statistics, or BLS, states the best measure of inflation for a given application depends on the intended use of the data. What are the economic problems caused by inflation, and why do economists often regard them with less concern than the general public? If other economic variables such as wages and interest rate do not move exactly in sync with inflation, or if they adjust for inflation only after a time lag, then inflation can cause three types of problems: unintended redistributions of purchasing power, blurred price signals, and difficulties in long-term planning. Let's take a look at the difficulties in long-term planning because of inflation. Imagine the problems arise for yourself while you are trying to save for retirement. You must consider what your money will really buy several decades in the future when you cannot know the rate of future inflation. You are not able to predict well what you can afford few decades from now if inflation rate is increasing quickly. On the business side, when a business spends its time focusing on how to profit by inflation, or at least how to avoid suffering from it, an inevitable trade-off strikes. Less time is spent on improving products and services or on figuring out how to make existing products and services more cheaply. When US inflation heated up in the early 1970s to like 10%, US growth in productivity slowed down, and when inflation slowed down in the 1980s, productivity edged up again not long thereafter, as shown in this graph. An economy with high inflation rewards businesses that have found clever ways of profiting from inflation, which are not necessarily the businesses that excel at productivity, innovation, or quality of service. In the short term, low or moderate levels of inflation may not pose an overwhelming difficulty for business planning because costs of doing businesses and sales revenues may rise at similar rates. If, however, inflation varies substantially over the short or medium term, then it may make sense for businesses to stick to shorter-term strategies. Inflation can also cause redistributions of purchasing power that hurt some and help some other people. People who are hurt by inflation include those who are holding considerable cash, whether it is a safe deposit box or in a cardboard box under the bed. When inflation happens, the buying power of cash diminishes. However, cash is only an example of a more general problem. Anyone who has financial assets invested in a way that the nominal return does not keep up with inflation will tend to suffer from inflation. For example, if a person has money in a bank that pays 4% interest, but inflation rises to 5%, then the real rate of return for the money invested in that bank is negative 1%. The problem of a good-looking nominal interest rate transforming into an ugly-looking real interest rate can be worsened by taxes. The U.S. income tax is charged on the nominal interest received in dollar terms without an adjustment for inflation. Thus, the government taxes a person who invests $10,000 and receives a 5% nominal rate of interest on the $500 received, no matter whether the inflation rate is 0%, 5%, or 10%. If inflation is 0%, then the real interest rate is 5% and all $500 is a gain in buying power. However, if inflation is 5%, then the real interest rate is 0 and the person had no real gain but owes income tax on the nominal gain anyway. If inflation is 10%, then the real interest rate is negative 5% and the person is actually falling behind in buying power but would still owe taxes on the $500 in nominal gains. Inflation can cause unintended redistribution for wage earners too. Wages do typically creep up with inflation over time eventually. However, increases in wages may lag behind inflation for a year or two, since wage adjustments are often somewhat sticky and occur only once or twice a year. Moreover, the extent to which wages keep up with inflation creates insecurity for workers and may involve painful, prolonged conflicts between employers and employees. If the government adjusts minimum wage for inflation only infrequently, minimum wage workers are losing purchasing power from their nominal wages. You also get hurt by inflation if you are retirees who receive a private company pension. Most pensions have traditionally been set as a fixed nominal dollar amount per year at retirement. For this reason, economists call pensions defined benefits. Even if inflation is low, the combination of inflation and a fixed income can create a substantial problem over time. A person who retires on a fixed income at age 65 will find that losing just 1 or 2% of buying power per year to inflation compounds to a considerable loss of buying power after a decade or two. However, some people can sometimes benefit from the unintended redistributions of inflation. Consider someone who borrows $10,000 to buy a car at a fixed interest rate of 9%. If inflation is 3% at the time the loan is made, then he or she must repay the loan at a real interest rate of 6%. So you take the nominal interest rate of 9% minus the inflation rate 3%. You get 6% real interest rate. However, if inflation rises to 9%, then real interest rate on the loan is 0. In this case, the borrower's benefit from inflation is the lender's loss. A borrower paying a fixed interest rate who benefits from inflation is just the flip side of an investor receiving a fixed interest rate who suffers from inflation. The lesson is that when interest rates are fixed, rises in the rate of inflation tend to penalize suppliers of financial capital who receive repayment in dollars that are worth less because of inflation, while demanders of financial capital end up better off because they can repay their loans in dollars that are worth less than originally expected. Last but not least, inflation blurs the price messages that convey information about conditions of demand and supply. Inflation means that we perceive price signals more vaguely, like a radio program received with considerable static. If the static becomes severe, it is hard to tell what is happening. In Venezuela, when inflation accelerated to an annual rate of more than 200,000% in 2019, many stores stopped posting prices directly on items, since they could have had to put new labels on the items or shelves every day to reflect inflation. Obviously, this situation makes comparing prices and shopping for the best deal rather difficult. When the levels and changes of prices become uncertain, businesses and individuals find it harder to react to economic signals. In a world where inflation is at a high rate but bouncing up and down to some extent, does a higher price of a good mean that inflation has risen, or that supply of that good has decreased, or that demand for that good has increased? We don't know. Should a buyer of the good take the higher price as an economic hint to start substituting other products? Or have the prices of the substitutes risen by an equal amount? Should a seller of the good take a higher price as a reason to increase production? Or is the higher price only a sign of a general inflation in which the prices of all inputs to production are rising as well? The true story will presumably become clear over time, but at a given moment, who can say? High and variable inflation means that the incentives in the economy to adjust in response to changes in prices are weaker. Markets will adjust toward their equilibrium prices and quantities more erratically and slowly. and many individual markets will experience a greater chance of surpluses and shortages. So is there any benefit of inflation? Although the economic effects of inflation are primarily negative, two countervailing points are worth noting. First, the impact of inflation will differ considerably according to whether it is creeping up slowly at 0% to 2% per year, galloping along at 10% to 20% per year, or racing to the point of hyperinflation at, say, 50% per month. Hyperinflation can rip an economy and a society apart. An annual inflation rate of 2 or 3 or 4%, however, is a long way from a national crisis. Low inflation is also better than deflation, which occurs with severe recessions. Remember, deflation means the overall price level is decreasing. Second, economists sometimes argue that moderate inflation may help the economy by making wages in labor markets more flexible. The discussion in unemployment chapter pointed out that wages tend to be sticky in their downward movements and that unemployment can result. A little inflation could nibble away at real wages and thus help real wages to decline if necessary. In this way, even if a moderate or high rate of inflation may act as sand in the gears of the economy, perhaps a low rate of inflation serves as oil for the gears of the labor market. This argument is controversial though. It does, however, offer another reason to believe that, all things considered, very low rates of inflation may not be especially harmful. Since the negative effects of inflation depend in large part on having inflation unexpectedly affect one part of the economy but not another, say increasing the prices that people pay but not the wages that workers receive, indexing will take some of the sting out of inflation. An index payment increases according to the index number that measures inflation. Those in private markets and government programs observe a wide range of indexing arrangements. Let's take a look at some examples of indexing arrangements in private markets, such as cost of living adjustment, COLAs, and adjustable rate mortgage, ARM. Cost of living adjustment, or COLAs, is a contractual provision that wage increases will keep up with inflation. These contracts were sometimes written as, for example, COLA plus 3%. Thus, if inflation was 5%, the wage increase would automatically be 8%. But if inflation rose to 9%, the wage increase would automatically be 12%. COLAs are a form of indexing applied to wages. An adjustable rate mortgage, or ARM, is a type of loan that one can use to purchase a home in which the interest rate varies with the rate of inflation. Often, a borrower will be able to receive a lower interest rate if borrowing with an ARM compared to a fixed rate loan. The reason is that with an ARM, the lender is protected against the risk that higher inflation will reduce the real loan payments. And so the risk premium part of the interest rate can be correspondingly lower. A number of ongoing or long-term business contracts also have provisions that prices will adjust automatically according to inflation. Sellers like such contracts because they are not locked into a low nominal selling price if inflation turns out higher than expected. Buyers like such contracts because they are not locked into a high buying price if inflation turns out to be lower than expected. A contract with automatic adjustments for inflation agrees on a real price for the borrower to pay rather than a nominal price. Many government programs are indexed to inflation. The U.S. income tax code is designed so that as a person's income rises above a certain level, the tax rate on the marginal income earned rises as well. Until the late 1970s, If nominal wages increase along with inflation, people will move into higher tax brackets and owe a higher proportion of their income in taxes, even though their real income had not risen. In 1981, the government eliminated this. Now, the income levels where higher tax rates kicked in are indexed to rise automatically with inflation. The Social Security program offers two examples of indexing. Since the passage of the Social Security Index Act of 1972, the level of Social Security benefits increases each year along with the Consumer Price Index. As yet another example of a government program affected by indexing, in 1996, the United States government began offering index bonds. Bonds are means by which the US government, and many private sector companies as well, borrows money. That is, investors buy the bonds, and then the government repays the money with interest. Traditionally, government bonds have paid a fixed rate of interest. This policy gave a government that had borrowed an incentive to encourage inflation because it could then repay its past borrowing in inflated dollars at a lower real interest rate. However, index bonds promise to pay a certain real rate of interest above whatever inflation rate occurs. In the case of a retiree trying to plan for the long term and worried about the risk of inflation, for example, index bonds that guarantee a rate of return higher than inflation, no matter what the level of inflation is, can be a very comforting investment. So this video has focused on how economists measure inflation, how to adjust nominal variables into real ones, how inflation affects the economy, and how indexing works. We barely hinted at the causes of inflation, and we have not addressed government policy to deal with inflation. We will examine these issues in depth in another video. Thanks for watching and bye for now.